We are in a huge financial bubble right now. Governments around the world have printed vast amounts of money. This includes Japan, the United States, and Europe. They have never printed this much before. When too much money floods the system, it can lead to serious problems. History shows us that excess money printing often ends in crisis. Asset prices have climbed much faster than wages for many years. Houses, stocks, and cryptocurrencies have soared to record levels. These rapid price rises form bubbles that can burst suddenly. When a bubble pops, prices fall sharply and people sell in panic. This causes big losses for many investors. We want to avoid a severe recession like the one in the late 1970s and early 1980s, when the prime rate reached 20% and bond yields hit 15%. That recession was brutal and long. In the late 1970s, Federal Reserve Chair Paul Volcker raised interest rates dramatically to fight high inflation. He set the federal funds rate near 20%. This move crushed inflation but triggered a deep recession and widespread hardship. Today's politicians may not allow such extreme action because high rates can slow growth and raise unemployment. That means the next crisis could look very different and possibly be harder to solve. When a nation prints too much money, it often ends up with strong leaders who limit freedoms. In some Latin American countries, excess money printing led to dictatorships and lost democracies. Plato warned that early Greek city-states lost their freedom when leaders manipulated the masses with promises. We must avoid that fate. We have already done something extreme by greatly expanding our money supply. We do not know if our path will mirror Japan's slow growth or end in a full collapse. We do know we are flirting with serious trouble. Japan has printed money for decades and its economy still struggles with low growth, high debt, and an aging population. If we keep adding debt without growing real output, we may face similar long-term issues. It is tempting for governments to pay off debt with newly printed money. They can remove interest payments and increase the money supply all at once. It seems like a free benefit, but when something is too easy, it is often overused. Printing money may feel like giving everyone a raise, but it slowly devalues savings and raises prices for everyday goods. I never try to predict daily market moves or which index will outperform another. Instead, I look for good opportunities and hold them for the long term. If you invest in stocks or real estate, you must accept both booms and busts. Learn to live through both. As Rudyard Kipling wrote, treat triumph and disaster the same. Do not celebrate wildly when prices rise and do not panic when they fall. Stick to your plan. Passive investing has grown hugely in recent years. Index funds now own a massive share of all stocks. The managers of these funds hold great voting power. They can influence corporate policies and board decisions, but they do not always engage deeply with each company. This could weaken corporate oversight and accountability. Passive investing makes markets more efficient in normal times, but it can amplify trends and reduce healthy competition. On the positive side, our economy and technology remain strong. Modern factories use robots to boost productivity. Automation is spreading worldwide, including in China. Innovation will keep driving progress, but it also creates challenges. Unionized factory jobs may vanish as machines take over. Entire industries can disappear when new technologies emerge. For instance, many retail jobs have moved online, and large stores now operate with fewer staff. Politicians and central banks often respond to crises by printing more money. It is the easiest choice, but it carries long-term risks. We have seen hyperinflation in Germany's Weimar Republic in the 1920s. That crisis destroyed savings, fueled political extremism, and helped bring Hitler to power. Excessive money printing can erode public trust and harm democracy. Once people learn they can vote for unlimited money printing, it is hard to stop without major pain. Inflation is one of the greatest long-term threats. A wise assumption for investors is that currency value will decline over time. To protect your wealth, seek assets that hold value or grow faster than inflation. Stocks, real estate, and hard assets like gold can help. Bonds can protect against deflation but suffer in high inflation. Keep a balanced portfolio. Global supply chains tie economies together. A factory shutdown in one country can cause shortages and price spikes worldwide. For example, the 2021 chip shortage slowed car production and raised vehicle prices by thousands of dollars. Shipping delays in key waterways or port strikes can disrupt trade. Diversifying supply sources can help, but many industries remain vulnerable to single points of failure. Investing wisely means planning for multiple scenarios. What if inflation stays high? What if growth rebounds? What if a new crisis hits? Preparing for different outcomes helps you adjust and avoid being caught off guard. Scenario planning can guide your asset allocation and risk management. Managing your personal finances also means creating a budget and controlling debt. Track your income and expenses each month. Aim to pay off high-interest debt like credit cards first. A good credit score can save you thousands in interest over time. Protect your wealth with adequate insurance for health, home, and auto. Insurance helps you avoid financial ruin in emergencies. Your health and well-being matter for long-term success. Good physical health supports clear thinking and energy. Exercise regularly, eat balanced meals, and get enough sleep. Mental health is just as important. Take breaks, practice mindfulness, and maintain social connections. A healthy mind and body help you make better financial decisions. Set clear goals and time horizons for your investments. Short-term goals might include building an emergency fund or saving for a car. Medium-term goals could be buying a home or funding education. Long-term goals often involve planning for retirement. Align your asset mix with your goals. Choose safer assets for near-term needs and growth assets for the long term. Review your portfolio at least once a year. Rebalance your assets to maintain your desired mix of stocks, bonds, and other investments. Rebalancing locks and gains from winners and buys more of assets that fell in price. Avoid concentrating too much money in one company or sector. Spread your investments across industries and regions to reduce risk. Take advantage of tax-advantaged accounts like 401ks, IRAs, and Roth IRAs. Contribute enough to get any employer match. Tax breaks can boost your returns over time. Keep fees low by choosing funds with small expense ratios. High fees can eat away at your gains. The Federal Reserve watches inflation, unemployment, and growth. If inflation stays high or unemployment falls too low, the Fed may raise rates to cool demand. If growth slows and jobs fall, it may cut rates to boost borrowing. These moves affect loan rates, mortgages, and your savings. Stay informed about Fed actions by reading reliable news and analysis. Right now, we face as many unknowns as we did in early 2020. Markets swing wildly. One day, stocks drop on tariff fears. The next day, they rebound when those tariffs are paused. We could end 2025 up or down, but volatility is almost certain. History shows that big policy shifts often lead to big market swings. Stay calm and stick to your plan. Uncertainty comes from many sources: inflation trends, central bank decisions, geopolitical tensions, and rapid tech changes. Global events like elections, conflicts, or health scares can spark sudden sell-offs or rallies. Company earnings and consumer surveys also drive sentiment, sometimes in unexpected ways. By keeping a long-term view, you can avoid overreacting to daily noise. To navigate this uncertainty, focus on fundamentals. First, manage risk. Protect your downside. Use stop-loss levels or hold safer assets for part of your portfolio. Second, find your edge. Know where you have an information or skill advantage. Third, make asymmetric bets. Limit losses but leave room for big gains. If you follow these principles, you can handle whatever comes next. Above all, decide with logic, not emotion. Make clear lists of pros and cons for any policy or investment. Do not cherry-pick data to fit your beliefs. Instead, weigh every angle. That is how you stay ahead in a world of trade wars, rate changes, and global shifts. Remember simple life rules. Avoid envy and resentment. Live within your means and stay positive despite troubles. Be honest and reliable. Treat people well and do your work right the first time. These rules can guide you through uncertainty and help you build a long, happy life. Build a community of peers who share your approach. Discuss ideas with friends or join an investment club. Learning from others helps you avoid blind spot, but be wary of groupthink. Always think independently and question assumptions. Stay curious and keep learning every day. Good luck, everyone.